So welcome, and thank you for taking the time from your busy schedule to listen to this webinar, which I hope you will find helpful and beneficial in your accounting studies. My name is Conor Foley, and I'm currently the examiner for Formation 2 Financial Accounting, and we're just going to spend approximately 30 minutes today discussing the current layout in accordance with the IFRS standards. Our webinar will focus on the difference between the old and the new layout of financial statements, with the new layout abiding by these international financial reporting standards. We will also work through an example using the new layout for financial statements. By looking at an example under this new format, it should help students to manage their time more effectively and ensure that marks are maximised in the traditional question 1B of the Formation 2 Financial Accounting paper, which is currently worth approximately 30% of the overall marks. Previously, the layout of the financial statements included what most of you will be very familiar with: a profit and loss account, a balance sheet, a cash flow statement, notes to the financial statements, and comparatives from the previous periods of the various figures and information for each of those: profit and loss, balance sheet, and cash flow statement. Our new layout of financial statements has changed elements and names of a lot of the main features of the financial statements. So, for example, the new layout includes what is known as a statement of comprehensive income, statement of financial position, statements of changes in equity, statement of cash flow, notes to the financial statements, and also our comparatives for the previous periods. In this webinar, I will concentrate on the changes in the Statement of Comprehensive Income and the Statement of Financial Position, as I feel these are the aspects of the financial statements which are most relevant to students preparing for their Formation 2 Financial Accounting exams. So, if we look there at the slide, our old layout was a profit and loss account, which the new layout now becomes the Statement of Comprehensive Income. If we take a moment to compare, and strictly speaking, the profit and loss account is covered under the new layout by what is known as the income statement, with the difference between the income statement and the Statement of Comprehensive Income being the addition of the new section called Other Comprehensive Income, which when added to the income statement becomes what we now know as the Statement of Comprehensive Income. In previous question 1Bs of the Formation 2 Financial Accounting paper, you have been asked to complete a Statement of Comprehensive Income, as there have been aspects in the question which have impacted on the income statement and other comprehensive income sections, and therefore this is why in the table above, for simplicity, we equate the old profit and loss account with the new Statement of Comprehensive Income. Moving on, the old balance sheet is now known as the Statement of Financial Position. I believe that there are pluses involved with both the old and the new names, because if you take the balance sheet by its very name, everyone would know that it had to balance, whereas taking the Statement of Financial Position name should ensure that one would know that it is a statement of the worth of a business at a point in time, which should aid an investor and meet a target of the International Accounting Standards Board, i.e. the IASB, one of whose main desires was to present accounts which are attractive from an investor to understand. The IASB believes that the title Statement of Financial Position not only better reflects the function of the statement, but is consistent with their conceptual framework, which contains several references to the word financial position. The IASB also believe that the term balance sheet is one which simply reflects that double entry bookkeeping requires debits to equal credits, and they believe it does not identify the content or purpose of the statement particularly well. They also noted that the financial position is a well-known and accepted term, as it has been used in auditors' opinions internationally for more than 20 years to describe what the balance sheet presents, and that's why they're very happy to use the Statement of Financial Position title now. Looking at the cash flow, previously known as a cash flow statement, now known as a Statement of Cash Flows, and in relation to Statement of Retained Earnings, this is now known as a Statement of Changes in Equity. The Statement of Changes in Equity include the following information, which is not an exhaustive list, but includes aspects which are most relevant to our Formation 2 level. So for each component of equity, i.e. their share capital, etc. of a limited company, there needs to be a reconciliation between the carrying amount at the beginning and the end of the period, whereby we look at the changes in profit or loss, other comprehensive income, and transactions with owners in their capacity as owners, for example the payment of dividends. So if we now move on to our statement of comprehensive income, this is effectively made up of two parts, one which is our profit or loss, and two, our other comprehensive income. The profit or loss is similar to the old profit and loss account in that it is the total of income less expenses. Note the word or now between profit or loss. It is either a profit or loss and not a profit and loss, as a company can't make a profit and loss, but instead it's either one or the other, i.e. a profit or loss. Our other comprehensive income comprises items of income and expenses that are not recognised in profit or loss as permitted by the IFRSs, and we will look at other comprehensive income and items not recognised in profit or loss later on in this webinar. We mentioned that our profit and loss is income minus expenses. So what are our definitions of income and expenses? Our definition of income encompasses both revenue and gains. Revenue arises in the course of the ordinary day-to-day activities of a company and is referred to by a variety of different names. For example, sales, fees, turnover, interest, dividends, royalty received, rent received. Gains represent other items that do meet this definition of income, but may or may not arise in the course of the ordinary activities of an entity. The gain which we are most familiar with would be a gain on the sale of a non-current asset like a motor vehicle, which when we compare the net book value or carrying value of the assets versus the sales proceeds of that motor vehicle, could mean that we make a gain or on the sale of that motor vehicle. Our definition of expenses encompasses losses as well as those expenses that arise in the course of the ordinary activities of the entity. Expenses include, for example, our cost of sales, wages and depreciation, as well as other expenses like accountancy fees, general expenses, rent and rate, etc. They usually take the form of an outflow or depletion of assets such as cash and cash equivalents, inventory or property, plant and equipment. Losses represent other items that meet the definition of expenses and may or may not arise in the course of the ordinary activities of an entity. So our losses could include, for example, those resulting from disasters such as fire and flood, as well as those arising on the disposal of non-current assets. So like the example we used for gains in the previous slide, a loss could also be incurred on the sale of a non-current asset like a motor vehicle. Our definition of expenses does also include unrealized losses. For example, those arising from the effects of increases in the rate of exchange for foreign currency in respect of a borrowing, and this would agree with the prudence concept or principle, whereby a loss has to be accounted for immediately, regardless of whether the loss is realized or unrealized. Moving on to other comprehensive income, components of other comprehensive income that we should be familiar with include revaluation gains or losses on property as per International Accounting Standard 16 on property, plant and equipment, and our gains and losses arising from translating financial statements of a foreign operation as per IAS 21 based on the effect of changes in foreign exchange rates. If we take the revaluation gain or losses, if we take a building which was revalued in the period from 2000 to 2007, when the Irish property boom, one would have expected that the building would have increased in value as part of property inflation at that time, and therefore the increase would be a revaluation gain. This gain would be accounted for by debiting our building and crediting the revaluation gain in other comprehensive income, and this increase or revaluation gain would also be taken to the revaluation surplus in the equity section of our statement of financial position. From 2007 onwards, with the crash in property prices, the building would likely have decreased in value, which would be accounted for by crediting our property or reducing that property in value, and debiting up to the value of the previous revaluation surplus by debiting our other comprehensive income, with any balance, if there is an excess balance of a loss, being taken as a loss to the profit and loss sections of our statement of comprehensive income. So if we now compare the main aspects of our profit and loss account versus the new layout of the statement of comprehensive income. So our first line always in the previous profit and loss account was sales or turnover. This is now covered by the term revenue. Cost of sales hasn't changed, and again gross profit is still the same. After gross profit, under both methods, other income, and then we come to expenses. Under the profit and loss account, expenses were optional to be classified under certain headings, and often these expenses were often listed all together on the face of a profit and loss account, depending on the size of that company. Under the statement of comprehensive income, our expenses are more mandatory to be classified under certain headings. For example, finance costs, distribution costs, administration expenses and other expenses. These expenses that I've just outlined are from the illustrative financial statement structure and presentation as per IAS 1 implementation guidance, and we're using the classification of expenses by function option throughout this webinar. There are not specific guidelines for the headings per se, but IAS 1 does state that at a minimum the following should definitely appear on the face of the statement of comprehensive income, and these items would include revenue, finance costs, tax expense, profit or loss, each component of other comprehensive income, and our total other comprehensive income. Continuing on by comparing our profit and loss account with our statement of comprehensive income, our net profit before tax is now known as a profit before tax. Corporation tax is now known as income tax. The IASB felt that investors would be able to understand the term income tax better, as they would be more familiar with it on a personal tax basis, and therefore this is what is used now for all standards in relation to tax. Our net profit after tax under profit and loss has now become, under the statement of comprehensive income, our profit for the year. The major changes then become that we have this new section classified as other comprehensive income, and we get our total comprehensive income for the year by adding our profit for the year plus our other comprehensive income in the statement of comprehensive income. As you can see therefore that a lot of the changes are subtle and appear to be minor changes in wording, but it's important that the new format and layout are followed, as the new layout is the future for financial statements and what will be used in the years to come. We now can move on to our statement of financial position. The statement of financial position is a snapshot of a company's assets, liabilities and equity at a point in time, which is usually at the end of the year, the 31st December. However, it can be at any other point of the year. So for example, if we take the likes of Greencore PLC, usually their year end is at say September, but that can be anything from the 25th to the 30th, as usually they take the last Friday in September as their basis for their year end. So therefore your year end can be at any point, but the majority of companies use the 31st of December. So given that the statement of financial position is a snapshot of assets, liabilities and equity, what are our definitions for each of these aspects per the conceptual framework? An asset is a resource controlled by the company as a result of past events and from which future economic benefits are expected to flow to the company. So if we take an example of an asset, so let's look at the purchase of a motor vehicle. Does a motor vehicle fit the definition of an asset? Does the company control it? Yes, they do. They purchased it and now own it and can do what they want with that motor vehicle. Our past event was the purchase of the motor vehicle, and the future economic benefits to flow to the company could be, for example, where the motor vehicle is used by a sales representative of the company to travel around the country or region making sales which bring money into the company. So therefore our motor vehicle does actually fit a definition of an asset as per the conceptual framework. A liability is a present obligation of the company arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. So again, let's use our motor vehicle example. If we had to get a loan from the bank to facilitate the purchase of our motor vehicle, would this loan fit into the example of a liability? The loan is the present obligation of the company to pay back the loan amount to the bank. The past event was using that loan to purchase the motor vehicle, and the settlement of the loan will involve the company paying monthly amounts back to the bank as a cash outflow from the company to the bank. So consequently, a loan does indeed meet the definition of a liability. Equity is the residual interest in the assets of an entity after deducting all of its liabilities. Remember the accounting equation, one of the cornerstones of accounting. Assets equal liabilities plus equity. So rearranging this formula would give assets minus liabilities equal equity. So going back to our example of motor vehicle, the difference between the cost of the motor vehicle and the value of the motor vehicle loan would be an example of the equity. So for example, if the motor vehicle's carrying value was €10,000, and this is also the amount that the company would get for it if they sold it immediately, and the bank loan on the motor vehicle is €6,000, then the equity of the company for that motor vehicle is a positive €4,000. So let's compare the differences between the new and the old layout for the balance sheet versus the statement of financial position. Starting off, the first line of our balance sheet was fixed assets. Under the statement of financial position, this is known as non-current assets. The next section is similar for both layouts, i.e. current assets. And then we move on to the current liabilities under balance sheet. Now this is the major change for the layout of the statement of financial position, in that the current liabilities move down to the very end under equity and liabilities under the statement of financial position. So reverting back to the balance sheet, current assets minus current liabilities will give our working capital, and depending on whether that was a positive or negative, it would be added or taken from fixed assets to get our net assets section. It's a simpler statement under the financial position. All we have to do here is add non-current assets to current assets to give us our total assets position. Then under the statement of financial position, you move on to equity and liabilities, which would previously have been known under the balance sheet format as represented by or financed by. So the first section of the equity and liabilities is equity. We add to that our non-current liabilities, which previously would have been under the balance sheet known as long-term liabilities. So equity plus our non-current liabilities and plus our current liabilities, which was the big movement under the new statement of financial position, will give us our total equity and liabilities. And that total equity and liabilities will have to equal your total assets figure above in the statement of financial position. So as we can see now, our statement of financial position is now a direct representation of the accounting equation, i.e. assets equal equity plus liabilities. Note also that all assets and liabilities are now classified as current or non-current. So current being less than 1 year, non-current being greater than 1 year. This is to facilitate investors' understanding of the financial statements, as the IASB felt it was easy for them to understand the difference between current and non-current. So we've now spoken about the new layout and terminology of the financial statements. So let's put this knowledge into practice by preparing a straightforward example using the information in the trial balance in this example to prepare the statement of comprehensive income and statement of financial position. So this would be a straightforward example of an exam type question, but the principles of applying oneself when we are attempting these exam questions are the same. So I would feel that it's important that we should recommend that students take a few minutes to review the question, highlight, underline or make notes about aspects or area of the questions that require particular attention, so as to ensure that these are not forgotten about when preparing the financial statements. If a student wants and feels that it is beneficial to them, they can at this stage identify where each line item will appear in the financial statements. So for example, starting at the start, the bank would be a current asset in the statement of financial position, working away down through it to get to wage and salaries being an expense in our statement of comprehensive income. But that is entirely up to how students feel they want to deal or tackle with the question. Students should also remember that in general, the debit side of the trial balance is for items that are either assets or expenses, whereas the credit side of the trial balance is generally for items that are either income, liabilities or equity. This point can often cut down the chances of making error when contemplating the correct placement of an item in the trial balance to the financial statements. We also have some other additional information that has come to our attention. So if we work down to points A to G, we have closing inventory, we have some calculations to perform on depreciation, our land was revalued to 350,000, there is a tax bill due at the year end of 25,000 which hasn't been accounted for yet, we've closing accruals, we have to have a bad debt due to the recessionary times, and point G is that all expenses are to be split 50-50 between distribution costs and administrative expenses. Point G is to ensure that all relevant expenses are included under either distribution costs or administrative expenses as a one figure item in the statement of comprehensive income, as per IAS 1, which we referred to earlier. As mentioned earlier, historically, depending on the size of the company, this may not have been done, and instead all the expenses may have been listed on the face of the profit and loss account, but that approach is no longer appropriate. My recommendation is to follow the following steps in answering the question. So I would start the question by preparing the workings, including doing some workings for cost of sales, distribution costs and administrative expenses, as these are now shown as a one figure item on the face of the statement of comprehensive income. I would then prepare the statement of comprehensive income, and then finish off by preparing the statement of financial position. The reason why I am recommending preparing the workings first is that in general for question 1b of Formation 2 Financial Accounting, the workings carry a strong percentage of the overall marks, and students can refer to previous marking schemes for confirmation of this. And by completing the workings at the start, it should help in the preparation of the Statement of Comprehensive Income and Statement of Financial Position, as these can now be completed in one go, as opposed to where maybe a student realises that if an amount had been excluded, and then on inclusion of that previously excluded amount, totals have to be recalculated, etc., thus costing the students valuable time in an exam. So let's start with the working. So working 1, I would propose that we look at the adjustments first. So the first adjustment was in closing inventory, so therefore we should debit our closing inventory in a current asset of the Statement of Financial Position and credit our closing inventory in cost of sales on the Statement of Comprehensive Income. Point B is in relation to depreciation. Depreciation is an expense and is also added to our accumulated depreciation, which is taken from the cost in the non-current assets section of our Statement of Financial Position. Our buildings here is the depreciation on them is 2% of cost. The cost of the building is 800,000, so 2% of the 800,000 is 16,000. Continuing in the same vein, our equipment is 10% of cost. Our cost of our equipment in the question is 150,000, therefore 10% of that works out at 15,000. And the last depreciation we have to deal with is in fixtures, is based on a 20% reducing balance method. So on the question, our fixtures, the cost of those is 75,000. The accumulated depreciation being brought forward in the trial balance from the previous year is 15,000, giving us a carrying value of 60,000. So 20% of the 60,000 then works out at 12,000 euros. So we debit our expenses and we credit our accumulated depreciation with those figures. Please note that the accumulated depreciation of the trial balance is the balance coming forward from the previous year and therefore is the opening balance for this year. Our Part C working relates to a revaluation gain or surplus that we've made in relation to the land. So we have to increase the value of the land in our property, plant and equipment. Therefore we debit the property, plant and equipment in non-current assets section of the Statement of Financial Position by 50,000, and we credit our revaluation surplus in other comprehensive income section of the Statement of Comprehensive Income with also 50,000. Part D is corporation tax, which is due at the year into the revenue, and it's our expense for the year is 25,000, so we debit our expenses and we credit our accruals in the current liability section of the Statement of Financial Position for 25,000. Part D is also accruals, so we debit our motor expenses as we're increasing the expenses because these are amounts that are due and should have gone into expenses this year. Therefore we debit our expense for 2,000, we debit the light and heat expense for 1,000 in the Statement of Comprehensive Income, and we credit our accruals in current liability section of the Statement of Financial Position with 3,000, the total amount of the 2 plus 1,000. Part F, we now realise we need a bad debt provision of 5% of trade receivables. Looking at the trial balance, the trade receivable figure is 80,000, 5% of that is 4,000, so we debit our bad debt provision in the expense section of the Statement of Comprehensive Income, and we credit the trade receivable current asset section of the Statement of Financial Position. Our second working is a working that's going to impact on the Statement of Comprehensive Income. We now need to work out what our total figures is for cost of sales, distribution costs and administration expenses. Remember that note G of the question says that all relevant expenses are to be split 50-50 between distribution costs and administrative expenses. So let's work down through the trial balance, taking into account any information in Part A to Part G, and see what figures should go in for each of these expenses. So under cost of sales we have our opening inventory in the trial balance of 50,000, purchases of 450,000, and then our working 1A from point A of our adjustments, where we have to take off the closing inventory of 55,000. Looking at then the other expenses, the first one there in the trial balance is insurance, which is 23,000. All our expenses are to be split 50-50, so this is why 11,500 goes into distribution costs and 11,500 goes into administrative expenses. Light and heat, the trial balance figure is 1,000, plus the accrual and working 1.E of 1,000, giving 2,000 in total, and again split 50-50 between distribution and administrative expenses. Marketing, there's no adjustment, so it's 24,000 split, 12,000 going into distribution, 12,000 into administrative expenses. And motor expenses, like light and heat, there is an adjustment here for an accrual, So the trial balance figure is 6,000 plus working 1.E of 2,000 accrual, giving 8,000 in total. We split it 50-50, so 4,000 goes into distribution costs and 4,000 goes into administrative expenses. We continue in the same vein for rates, rent, repairs and maintenance, and wages and salaries, where we split them 50-50 into the relevant expenses. Or we also have to consider the adjustments for bad debt provision, so working 1.8 4,000 to split 50-50, as is the three depreciation figures for building, equipment and fixtures. At this stage we should have ticked off all the various expenses from our trial balance, and as a consequence we're now in a position where we can do our totals. So when we add up the pluses and the minuses for cost of sales, we get a total of 445,000. For distribution costs we get 106,000, and for administrative expenses we also get 106,000. And these totals are the figures which will appear now on the face of the statement of comprehensive income when we go to prepare that. Our next working is our working in relation to property, plant and equipment for non-current assets section of the statement of financial position. We start off by looking at our cost less our accumulated depreciation brought forward, which will give us our opening carrying value of the non-current assets at the start of the year, and all this information is taken directly from the trial balance. From that we subtract the depreciation which we previously calculated in working 1.B, and we add our revaluation gain for working 1.C of 50,000, giving us our closing carrying value for land at the 31st of December of 350,000, building being 584,000, fixtures closing carrying value 45,000, equipments 93,000, and the overall total for property, plant and equipment, which will go directly on the face of the statement of financial position, being 1,072,000 for the year. Our last working is a straightforward working in relation to trade receivables, and all we're doing here is taking off the bad debt provision which we calculated in working 1.F of 4,000 and taking that from the trade receivable figure in the trial balance of 80, giving a net figure which will appear in current assets section of the statement of financial position of 76,000. These workings will make even more sense in questions with more detailed aspects to them, so I would recommend people to seriously consider having these workings in a neat and presentable manner when they are in the exam. At this stage we're now in a position to prepare the statement of comprehensive income and statement of financial position, as all relevant workings have been completed. So, taking the information in the trial balance and adding any relevant information for workings, we can now be in a position to list the totals for income and expenses to get our profit for the year, which will be the after-tax figure. So we start off with our revenue figure. We then move on to the totals which we calculated for cost of sales to give us gross profit, as well as then putting in the distribution costs and administrative expenses from working 2. So as you can see, it's quite quickly then to prepare the statement of comprehensive income. At this stage then, this gives us a profit before tax at 293,000. From this we take the income tax working 1.D of 25,000, giving us a profit for the year of 268,000. As mentioned earlier, the layout for the statement of comprehensive income is very similar to the layout for the traditional profit and loss account, so therefore students should be familiar with arriving at the totals for this stage, with the only major change being the use of a working to get the one figure items for cost of sales, distribution costs and administrative expenses. We now move on to the other comprehensive income section, where we include the revaluation gain on the land of 50,000 from working 1.C. If we add the other comprehensive income total of 50,000 to the profit for the year total of 268,000, this will give us our total comprehensive income figure of 318,000, and therefore we have completed the statement of comprehensive income, and we can proceed to the statement of financial position now. So, as previously seen, we start off our first line in our non-current assets is property, plant and equipment. We've calculated that already in working 3 as being 1,072,000. To this we add the goodwill figure, which is of 80,000, which is accounted for as an asset, as it would generally be in the seen in the business for greater than the year, and this is why the IASB includes under non-current assets. We add up the total for property, plant and equipment and goodwill, giving a total for non-current assets of 1,152,000. Moving on to current assets, we have inventory, trade receivable and cash equivalents. Our inventory comes from working 1.A of 55,000, and that's our closing inventory because we're doing our accounts to the closing position of the year, i.e. the 31st of December. Our trade receivables comes from working 4 as being a net figure of 76,000, and our cash equivalents is the bank figure from the trial balance, and we are just including it under cash equivalents as that is the terminology as laid down by the International Accounting Standards Board. Therefore, total current assets of 211,000, and to finish off the first section here, we add our total non-current assets figure of 1,152,000 to our total current asset figure of 211,000 to give a total assets figure of 1,363,000. Then we move on to the second half of our statement of financial position, namely equity and liabilities. We start off with the equity section and we put in our figures for share capital, share premium and other reserves directly from the trial balance. Note in this question the retained earnings brought forward was 0, and to that 0 figure we add the profit for the year of 268,000 from the statement of comprehensive income, and therefore our closing retained earnings is 268,000. The revaluation surplus brought forward was 20,000, and to that we add the 50,000 from other comprehensive income to give a closing figure of 70,000. And therefore we ensure the equity section has been increased in total by 318,000, which was the total for total comprehensive income figure when we prepared a statement of comprehensive income. And this shows where the statement of comprehensive income feeds into our statement of financial position under this equity section. So our total now for equity is 831,000. Continuing on, we move on to non-current liabilities, and we include the bank loan here. We're assuming here that the bank loan is non-current in nature, i.e. will be paid back after 1 year. In an exam generally there is usually some hint to identify if a loan is current or non-current in nature. Current liabilities includes our trade payables and accruals of 3,000, which was the light and heat of 1,000 and our motor expenses of 2,000, and then we have our income tax figure of 25,000 owing to the revenue at the year end. So a total for our current liabilities is 77,000. Remember as well that this is where the new position should be for current liabilities in this new layout of a statement of financial position, at the very end of the equity and liability section, whereas previously in the balance sheet it was taken from current assets. So be mindful of that when you're preparing the statement of financial position in exams. To finish off the statement of financial position, we have to get the total of equity and liabilities, so we add our equity figure there, which was 831,000, to the total non-current liabilities figure of 455,000, to the total of the current liabilities 77,000, and therefore the total equity and liabilities figure becomes 1,363,000. This ensures if we revert back up to our total assets that the two figures are exactly the same, and therefore our statement of financial position is now correct and balanced. So in conclusion, I would like to take this opportunity to thank you for listening, and I hope this webinar has been helpful and beneficial to your studies of financial accounting. So thank you very much.